Welcome back to EMSR AG Asian Guy. I need you to stop everything you are doing right now. I need you to put down your phone. I need you to close the other tabs. I need your complete and undivided attention for the next hour because what I am about to reveal is going to fundamentally shatter how you understand the silver market. The number you are about to see is going to make you question everything you thought you knew about price discovery. If you are looking at your trading screen right now, you are probably seeing silver hovering around $100 per ounce. You are seeing the green candles. You are watching the price push and grind. You are probably feeling pretty good about yourself. You bought silver at 60 or 70 or 80, and now you are watching it break through triple digits. It feels like victory. It feels like the finish line is in sight. But I'm here to tell you that what you are seeing on your screen is not the complete picture. The $100 price is not the real price. It is a controlled number. It is a paper fantasy that has completely disconnected from physical reality. And I can prove it to you with one number from the other side of the world. I have just received the latest pricing data from the Shanghai Gold Exchange. I have been tracking this market obsessively for the last 72 hours. I have been refreshing my screens at 3 in the morning. I have been cross-referencing multiple data sources. And the number I am looking at right now is not $100. It is not $105. It is not even $110. The Shanghai Gold Exchange is pricing silver at $115 per ounce. $115. Let that sink in. While you're sitting there staring at $100 on your COMEX screen, while you are celebrating the breakthrough to triple digits, the largest physical silver market on the planet is trading at $115. The gap between these two numbers is not small. It is not a rounding error. It is $15 per ounce. That is a 15% premium. In the world of commodities trading, a 15% spread between two major markets is not an inefficiency. It is a scream. It is the sound of the global pricing mechanism breaking apart at the seams. Think about what this means. If you are holding silver in a vault in New York and you see Shanghai paying $115 while New York offers $100, you have a decision to make. You can sell locally for $100 and walk away. Or you can take delivery of your metal, put it on a cargo plane, ship it to Shanghai, and sell it for $115. You capture $15 per ounce in pure profit just by moving the metal from where it is disrespected to where it is valued. This is not theory. This is not speculation. This is happening right now in real time. This is why the COMEX vaults are hemorrhaging metal. This is why the registered inventory is collapsing. This is why the warehouse reports show millions of ounces walking out the door every single week. The arbitrage vacuum created by this $15 gap is sucking physical silver out of the Western financial system and depositing it in Asia. Let me put this in perspective for you. When my competitor channels talk about a $10 gap, they get excited. They call it historic. They call it a market dislocation. But we are not looking at $10. We are looking at $15. We are looking at a gap that is 50% larger than what anyone else is reporting. The situation is more extreme than even the silver community realizes. Now I need you to understand why this gap exists, because the explanation reveals everything wrong with the Western financial system. The COMEX price of $100 is a paper price. It is determined by traders buying and selling futures contracts. These contracts represent silver that may or may not exist. The traders never touch the metal. They never take delivery. They trade electrons on a screen. The price they generate has become completely detached from the physical world. The Shanghai price of $115 is a physical price. It is determined by actual buyers who need actual metal for actual industrial production. When a solar panel factory needs silver for electrical contacts, they buy on the Shanghai Gold Exchange. When an electronics manufacturer needs silver for circuit boards, they buy on the Shanghai Gold Exchange. These buyers cannot accept paper promises. They need the metal in their hands, and they are willing to pay $115 to get it. The $15 gap is the market measuring the difference between paper fiction and physical reality. It is measuring the lie. And every day that gap stays open, it proves that the Western price is wrong. But here is where the story gets even more explosive. Despite this massive arbitrage opportunity, despite the fact that traders can make 15% profit by simply moving metal from west to east, the gap is not closing. The Shanghai premium is persistent. It has been running for months. In some periods, it has been even wider. Why does the gap persist? Why has arbitrage not eliminated the spread? The answer is devastating for anyone who believes the paper market price. There is not enough physical silver left in the West to arbitrage away the premium. The vaults have been drained. The metal that could have been shipped to capture the $15 profit has already been shipped. What remains is either locked up in long-term storage, committed to industrial users who cannot release it, or held by investors who refuse to sell at $100 when they know the real price is $115. The paper traders can sell all the contracts they want at $100. They can push the COMEX price down, they can paint the charts, they can try to shake out weak hands. But they cannot conjure physical silver out of thin air, and without physical silver, they cannot close the gap with Shanghai. This is the trap. This is the endgame. The paper market is fighting a war it has already lost. Shanghai is setting the real price. New York is pretending the old price still matters. And every single day, metal flows from the pretenders to the realists. Now, let me give you the export data that proves the flow is accelerating. China's customs records show that approximately 5,100 tons of silver were shipped out of the country last year. 5,100 tons. That is the highest volume of exports in at least 16 years. Some analysts say it may be the highest volume ever recorded. When I first saw this number, it seemed contradictory. If China values silver at $115, why are they exporting record amounts? Why are they sending their silver to the rest of the world? It took me days of research to understand the strategy, and when I finally cracked it, I realized this is the most bullish signal imaginable. The majority of Chinese silver exports flow through processing trade arrangements. Here is how it works. Raw silver ore and concentrates are imported from mines in Peru, Mexico, Chile, Australia. Chinese refineries process this material into finished bars. Then they export the refined product to global markets. The key insight is that China has positioned itself as the refining choke point for the entire world. It does not matter where the silver comes from originally. If it gets refined in China, China controls its destination. They can send it to export markets, or they can redirect it to domestic consumption. The valve can turn at any moment, and the infrastructure to turn that valve already exists. Since 2019, China has maintained a licensing regime for silver exports. Refiners must obtain export licenses from the Commerce Ministry. Last October, a document was issued extending this licensing regime through 2026 and 2027. The Western media dismissed this as routine. They said nothing changed. They called the market reaction misinformation. But they missed the point completely. The mechanism for restrictions is already operational. The licenses can be modified. The approval process can slow down. The volume can be throttled. All it takes is one policy update, and those 5,100 tons become zero. Look at what China has done with other strategic materials, rare earths, gallium, germanium, antimony. The pattern is always the same. First, they dominate processing. Then they dominate exports. They flood the world with supply. They drive out Western competitors. They create dependency. And when the dependency is complete, they restrict supply and weaponize the shortage. Silver is following the exact same playbook. The record exports are not generosity. They are strategic. China is cementing control of global silver refining while simultaneously building domestic strategic reserves. When the time is right, the exports stop. And the West discovers that it has no alternative source. The $115 Shanghai price is the early warning signal. It tells us that Chinese industrial demand is already outpacing willingness to export at the margin. Manufacturers in Shenzhen are willing to pay a $15 premium because they need the metal to keep their factories running. When domestic demand starts outbidding export demand, you know the transition is coming. Let me give you the industrial numbers because this is where the math becomes undeniable. China controls over 80% of global solar panel production. Every solar panel requires silver for its electrical contacts. There is no substitute. Silver has the highest electrical conductivity of any metal. You cannot make an efficient photovoltaic cell without it. The world installed over 400 gigawatts of solar capacity last year. Projections call for installations to exceed 1 terawatt per year by the end of this decade. 1 terawatt is 1,000 gigawatts. Each gigawatt of installed solar capacity requires approximately 250,000 ounces of silver. Do the math with me. 1,000 gigawatts times 250,000 ounces equals 250 million ounces per year, just for solar. Total global silver mine production is only 800 million ounces per year. By the end of this decade, solar alone will consume over 30% of all the silver mined on planet Earth. Now add electronics, add electric vehicle batteries, add medical devices, add water purification, add military applications. The total industrial demand is exploding while mine supply remains flat. We are staring at a structural deficit that cannot be solved by recycling or increased production. And where is all this industrial consumption centered? Asia, China, the same region where silver trades at $115 while America celebrates hitting 100. The Shanghai premium is the market correctly pricing the future. The COMEX price is the market denying reality. One of these numbers is right and one is wrong. And I think you know which is which. Now I need to address the narrative warfare being deployed against you. The word you keep hearing from mainstream analysts is misinformation. They are telling you that the fear of Chinese export restrictions was based on rumors. They are pointing to the record exports as proof that restrictions are not coming. They are calling the silver rally a FOMO bubble created by social media. I want you to think carefully about who benefits from this narrative. If retail investors believe supply constraints are coming, they buy silver. If they buy silver, the price rises. If the price rises, the massive short positions held by banks and commercial traders lose billions of dollars. So who benefits from convincing you that the supply story is false? The shorts do. The paper manipulators do. The same institutions that have been suppressing silver for decades. They are not providing analysis. They are providing cover fire. They are trying to shake your conviction so you sell your physical metal to them at $100. They will then turn around and sell that metal in Shanghai for $115. They will pocket your $15. And they will laugh at how easy it was to take it from you. Do not let them. The Shanghai price is visible to anyone willing to look. The $15 gap is documented fact. The export licensing infrastructure is a matter of public record. None of this is misinformation. It is the information they do not want you to have. Now let me talk about India, because India is the other major force driving this market. India is the largest importer of silver on the planet. They consume hundreds of millions of ounces every year for jewelry, religious ceremonies, and industrial use. Silver is deeply embedded in Indian culture. When Indian buyers perceive any threat to future supply, they act immediately and decisively. When the October licensing document hit, Indian investors went into a buying frenzy. It coincided with the Deepavali festival, which traditionally drives silver demand. Bullion dealers reported unprecedented volumes. Small bars and coins were particularly popular. The surge in Indian buying drained liquidity from the London market and helped push prices to levels not seen since the 1970s. The mainstream claimed this was panic based on misinterpretation. They said Indian media got the story wrong. They implied that unsophisticated retail buyers were fooled by rumors. But here's what they leave out. According to the latest reports from major Indian refiners, demand has not slowed down since October. It has actually increased. Investor demand for silver is now higher than it was during the festival period. Indian buyers are looking at $100 and seeing opportunity. They are looking at the Shanghai premium and understanding that the Western price has room to rise. India is not buying based on misinformation. India is buying based on correct information that the West refuses to acknowledge. The combined effect of Indian physical demand, Chinese industrial consumption, and arbitrage pressure is creating a perfect storm. Metal is flowing out of Western vaults at an unsustainable rate. The $15 Shanghai premium is the vacuum sucking inventory eastward, and the gap shows no signs of closing because the West is running out of metal to ship. Let me take a moment to speak directly to this community. If you're watching MRAG Asian Guy right now, you are not here by accident. You found this channel because you wanted the truth. You wanted someone who would dig into the Shanghai data. You wanted analysis that goes beyond the headlines. This is the only channel providing this depth of research. We are only on YouTube. We do not have a Telegram group asking for money. We do not have a WhatsApp channel with paid signals. We do not sell courses or trading alerts. There are copycat channels stealing our content word for word. They do not have access to the same sources. They do not understand what they are copying. If this analysis is valuable to you, I need your help. Go to the comments right now and type 115 signal. Let me know that you understand the significance of the Shanghai price. Share this video with one person who is still looking at $100 and thinking they know the real price. Subscribe if you have not already. Hit the notification bell so you never miss an update. We are in the middle of a historic repricing event. I need this community informed and prepared. Now let me explain what happens next. The $100 COMEX price and the $115 Shanghai price cannot coexist indefinitely. These numbers are incompatible. One of them must move toward the other. Will Shanghai drop to meet COMEX? Absolutely not. The Shanghai price is set by physical buyers who need the metal for manufacturing. They cannot bid less because their competitors will outbid them and secure the supply first. Industrial demand creates a floor that cannot be broken without factories shutting down. And factories are not shutting down. They are running at full capacity, trying to meet solar panel orders and electronics demand. So COMEX must rise to meet Shanghai. The paper price must be dragged upward toward the physical price. The arbitrage pressure is unrelenting. Every day the gap stays open, more metal leaves the West. Every day the COMEX vaults get lighter. Eventually the paper game collapses because there's nothing left to pretend with. This is why $100 is not the real price. It is a rearguard action. It is the shorts fighting to survive. But they are fighting gravity. They are fighting the fundamental physics of a market where demand exceeds supply. The question is not whether COMEX will converge to Shanghai. The question is how fast. If the convergence is gradual, we could see silver climb from 100 to 115 over several weeks. The banks would bleed out slowly. The short positions would be unwound in an orderly fashion. But if there is a catalyst, a headline, a policy change, an export restriction, then the convergence happens in days. The price gaps overnight. The paper market loses control. We wake up one morning to see silver quoted at 115 or 120 or 130 with no pullback. The risk for anyone not holding physical silver is asymmetric. If nothing happens, you miss a $15 move. If something happens, you miss the entire repricing. You're locked out. The metal is unavailable at any price. Now, let me give you a framework for thinking about ultimate price targets. Gold is currently trading near $5,000 per ounce. Throughout history, the natural ratio of gold to silver has averaged approximately 15 to 1. This ratio reflects the relative geological scarcity of the two metals. For most of human history, this ratio held steady. If we apply the historical ratio to current gold prices, we get a silver target of $330 per ounce. At $100, silver is trading at a gold ratio of 50 to 1. Even at 115, the ratio is over 43 to 1. Both numbers are massively above the historical norm. If the ratio normalizes even partially, silver has hundreds of percent upside from current levels. The Shanghai price of 115 is not expensive. It is the beginning of a revaluation that could take silver to 200, 300, or higher. I am not giving you a timeline. I'm not telling you to bet your life savings. Markets move in waves. There will be pullbacks. There will be volatility. The shorts will fight every step of the way because their survival depends on keeping the price suppressed. But the direction is clear. The Shanghai premium is your compass. It points up. And every day that 115 stays above 100, it confirms that physical reality is winning and paper fantasy is losing. Here's my message as we close this analysis. The $115 Shanghai price is the most important number in the silver market today. It is more important than the COMEX close. It is more important than the London fix. It is more important than anything any analyst says on television. It is the price that real buyers pay for real metal in the real world. When someone tells you silver is in a bubble, show them the Shanghai price. When someone tells you the rally is based on misinformation, show them the $15 gap. When someone tells you to take profits at 100, ask them why they would sell at 100 when Shanghai is paying 115. The gap is your proof. The vault drains are your confirmation. The export data is your timeline. Everything is pointing in one direction, up. We are witnessing the repricing of silver in real time. The paper markets are being dragged kicking and screaming toward the physical reality. The banks can fight it. They can sell paper. They can run propaganda. But they cannot create silver out of thin air. And they cannot stop the flow of metal from west to east. You are positioned correctly. You are informed. You understand what the $100 price really means and what the $115 price really signals. Do not let them shake you out. Do not let the misinformation narrative make you doubt what you see with your own eyes. The Shanghai Gold Exchange is paying $15 more than the COMEX. That is the only fact that matters. Hold your mettle. Ignore the noise. Watch the Shanghai price. And understand that the triple-digit era is not ending at 100. It is just beginning. This is Mr. AG, Asian Guy. Thank you for watching to the end. Thank you for being part of this community. Subscribe, share, and I will see you in the next analysis. The $115 signal is flashing. The real price is visible. The question is whether you are paying attention. Stay safe, stay stacking. And remember, the Shanghai price is the truth they do not want you to see.